If you're thinking about selling your business, there's a high likelihood that some portion of the total transaction will include seller financing. According to current statistics, closed deals with a sales price range between $1 million and $2 million on average, 80% of closed deals had some form of seller financing. So if you're selling a business under $2 million, there's a high chance that there'll be seller financing involved. As a business broker working with business owners who are ready to sell, I've handled advertising and marketing for hundreds of businesses. Given the high likelihood that a small business is going to have some portion of the deal on seller financing terms, let me outline some things you should be aware of when it comes to seller financing. Hi, my name's Trent Lee. I've sold over 600 businesses, and in the last 5 years, I've been named the #1 business broker in the country for the most closed transactions 5 years in a row. I make these videos so that you'll know what to do to better prepare when you're ready to sell your business. Tip number 1, advertise seller financing terms on your business listing. In the small business industry, the buyer pool is much larger for sellers who offer seller financing. Not only will you find your potential buyer quicker, but you'll also be able to request a higher sales price rather than wait for an all-cash buyer who will typically want a discount on the asking price. Tip number 2, consider seller carryback terms. The terms that you agree to will be unique to your business, but I've found that the terms typically range between 2 and 7 years, depending on the amount being financed. Interest rates for seller financing are often somewhere between 6 to 12%, depending on the current environment. However, interest rates have a lot to do with the specifics of the deal and the ability of the buyer and the business to service the loan payments. So you need to work with a business broker that can help you calculate that properly. Tip number 3, assess the buyer's qualifications. Do you trust that the buyer is someone that has experience, that has a competent personality to continue to operate the business profitably? This and other questions are important that you get comfortable with so that you are comfortable with the buyer and their ability to perform and pay you on time. Some sellers check the buyer's personal credit and background, as well as ask for a resume to get a better idea of the buyer's background and experience. Training and experience are important to make sure that you understand that the buyer has the ability to operate. This gives you the assurance that your payments will continue to come in on time. Tip number 4, leave the DIY, do-it-yourself mentality at the door. When buyer and seller try to handle closing outside of an escrow or an attorney who specializes in business transactions, this spells disaster. I've personally witnessed that it does not end well for either party. As a seller, be sure to have a professional draft the seller financing note. This is for your own protection. You'll want the buyer's personal guarantee written in a promissory note as well as a security agreement. Legal counsel should handle this important aspect. A do-it-yourself mentality has no advantages, as this is a vital stage in the transaction. Next, ask for collateral. In real estate, you hold the property itself as collateral. However, in a business transaction, there's often less collateral to hold on to as the seller. You can collateralize the assets of the business or be in a second position if there's a bank financing involved. But you also want to make sure that the buyer has personal assets that they're willing to pledge as collateral. At a minimum, have a security interest with a UCC1 lien filed for your own protection. Tip number 6, consult a tax advisor regarding the benefits. By accepting part of the purchase price on terms and spreading out the payments over the term period, your taxable income from the transaction is spread over that same period. Consult your tax advisor to understand how this affects you and your personal situation. It will likely lower your taxable income. Tip number 7, require a sizable down payment from the buyer. Seller financing is not without its risk. One way to help mitigate this is to require a sizable down payment from the buyer. This helps minimize your exposure by ensuring that the buyer faces a greater risk if they were to default. Unlike a home loan, where the buyer can put down as little as 3 to 5%, in a business transaction, you'll want to collect a down payment of more than 50% so that the buyer has more to lose than you do. Unless you have a legitimate reason for financing less than 50% down, I wouldn't advise it. I've seen successful deals close with low down payments, but this is the exception to the rule. It might occur in a case where an employee or a manager is buying out the business, you're selling to family members, or you have a friendly relationship, or maybe even a friendly competitive relationship. Those have worked, but traditionally, I don't suggest collecting less than 50% down. If you're considering seller financing on your business, the first step is to determine how much your business is worth and how long it will take to sell it. I make these videos so that you can know exactly who to reach out to help you with that process. As a business appraiser, feel free to reach out. I can help you determine the fair market value of your business, as well as how long it will take to sell the business. But here's the best part. When we take it to market, I'll never ask you for any money up front. I only get paid if I bring you an acceptable offer that you are happy with and you've been paid in the transaction. So there's absolutely no risk for you to go through the process to find out how much your business is worth, how long it will take to sell it, and have a business broker present you options.